Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm excited that you've joined me today. We do this webinar live every week to help you learn the ins and outs of passive investing so you can go into your first or next deal with confidence. Now, we talk about all various topics, sometimes related to tax, finances, and investing mindset. This week, we're going to talk about tax-free wealth, how to maximize your note fund investing by utilizing a Roth IRA. Now, if this is your first time joining us, make sure to that you're on our list at passiveinvestingwithwhitney.com. There, you will get access, priority access to our open deals, but you will also see all of our other education around investing, as well as our skill building boot camps. And again, remember that's passiveinvestingwithwhitney.com. Now let's dive into today's topic, tax-free wealth, how to maximize note fund investing through a Roth IRA. Now, maybe you're in the right place. Let me just say that, not maybe, but you are in the right place. If you want to learn how to turn your active income into passive income and wealth, maybe you tried investing before and just couldn't quite get comfortable with a passive real estate investment. Maybe you actually invested in a deal before and realized I might have made a mistake, or you're just simply here to sharpen your skills. Now, if we haven't met before, again, my name is Whitney Elkins-Hutten. I have been investing in real estate since 2002. I'm now a partner in over 800 million in real estate assets, including residential real estate, self-storage, express car washes, and various other businesses. I've done the whole flipping game of over 5 million in residential flips. I am the Director of Investor Education here at PassiveInvesting.com, and I also authored the book Money for Tomorrow with Bigger Pockets. So Money for Tomorrow, how to protect, how to build and protect generational wealth. Now, in that book, I outline my results, how I'm able to use passive investing to get 100% control and choice on how I spend my time. And I want to tell you that we can help you do that here at Passive Investing as well. We have helped our investors, acquire over 51 million in distributions through our debt fund investing, as well as our equity investing. So make sure that you're on the list at our Passive Investing Club. Again, that's passiveinvestingwithwhitney.com. Now, today we're going to talk about Roth IRAs and how to generate tax-free wealth. Okay, but here's the thing. This is not financial advice, legal advice, tax advice. Make sure to take what I say back to your investing team to make sure that it fits your situation, because there are some rules when it comes to a Roth IRA, and we need to know how these apply to your particular situation. So let's dive right on in. First of all, did you know that taxes can erode up to 40% of your retirement returns? And the earlier you start investing in a retirement account, especially on the taxable side of things, and the more you contribute, the more that you get from your employer as far as a match means more taxes. Okay. Now, what if you could legally eliminate those taxes while still growing a stable, predictable income stream? Okay, sound too good to be true? I mean, when somebody told me that, that's exactly what I thought. Now, here's the thing. Note investments, like investing into a debt fund or debt note fund, when you pair that in a Roth IRA, we get some very powerful benefits here. But let's first start off with what is a debt fund or a debt note fund. Well, debt funds or note fund investments, they're not on the equity side of things. They're on the debt. Essentially, you're being the bank, okay? You're lending money, and it's often secured by an asset like real estate. Now, you can go into a debt fund that backs businesses. You can go into a debt fund that backs ground-up development. You can go, there's all different flavors. But for our purposes here today, we're going to talk about two specific type of real estate backed assets, which are debt funds that are first lien mortgage notes. Okay, we'll get a little, into it a little bit more exactly what we're talking about, but also promissory notes, which are notes that are backed by a business. Now, note funds are ideal for investors because they can actually provide stability within the portfolio. They provide stability, they lower the volatility compared to stocks and other equity real estate investments. They can kick off some consistent and predictable cash flow, and they help diversify your portfolio. We've been talking a lot about that lately with our investors, is making sure that when you invest in real estate, that you're investing in all different layers of the capital stack. Now, if you don't know what I'm talking about there, we'll do a quick recap here in a second, but think about this. If you're in real estate, maybe this applies to you. You've been investing for the past, say, 5 years in private equity real estate. And the last 2 or 3 years have been kind of a struggle because all of your equity investments, no matter if they're in multifamily, self-storage, industrial, have had some cash flow issues. Why is that? Well, you got to step back and think, did I invest in the same layer of that equity stack, the capital stack across all those investments? So when we add in a note or a debt fund investment, that we're investing in a different layer of the capital stack. Okay, now that we've kind of anchored ourselves and we understand what note investments are, debt investments are, and why it's important to consider that as a way to diversify your portfolio, add in some stability, how can we supercharge this investment moving forward, right? Because one of the reasons why a lot of investors are a little leery to add in debt fund investments to their portfolio is the debt fund investments generally don't kick off depreciation. And, we're classically trained in real estate, that we want depreciation to shelter our returns, okay? We are creating velocity. So how then can we shelter the returns that are being kicked off by these debt fund investments or note investments? Well, this is where the Roth IRA specifically can be a huge advantage. Okay, so the Roth IRA is a specific type of retirement account where investments actually grow tax-free and withdrawals are tax-free as well, as long as you meet a few simple rules. Okay, now Roth IRAs are very different than traditional IRAs. Okay, this takes advantage of a separate part of the tax code. All right. Now, Roth IRAs are very, powerful tool because they grow tax-free, the funds come out tax-free, there's no tax erosion to your gains. All right. Now, whatever money you put in there has already been taxed. All right. So there is a teeny bit of tax that's owed. It's owed one time up front, but the money from there, once it's in the Roth account, can seriously compound and grow tax-free, right? Meaning that because it's growing tax-free, it's compounding tax-free, and it comes out tax-free to you. That is truly the eighth wonder of the world, according to Albert Einstein. Okay, now why notes are a perfect fit is because unlike real estate equity, investing in notes, when they go into a retirement account, they generally don't trigger a tax themselves. All right. So sometimes when you invest in an equity deal and you put that into an IRA, it can trigger what we call unrelated business income tax. Think of this as like second grade math. Okay. You have a tax advantaged account that is -1, and you take a tax advantage asset like real estate, equity real estate, that's -1. -1 times -1 gives you +1. It gives you taxes. Notes don't do that, okay? Because you're the bank, you're getting paid interest, it's being taxed. That interest, if you were holding it in your personal name, would be considered ordinary income. But because you have it in a Roth IRA, it is now sheltered, okay? So essentially, we're taking an investment that kicks off stable, predictable income and putting that otherwise would be taxed, and we're putting it in a truly tax advantage account to where it can grow tax-free and continue to compound for you. All right, so what does this look like over time? Most people are trying to figure out, how to take advantage of Roth accounts, either super early in life, maybe, if you're fresh out of like college and in your first job, sometimes it makes sense to invest in a Roth or, put your money into a Roth IRA and allow it to grow. We've got time working on our side. But for most of the people that are listening to this, you're probably a high income earner. And so you kind of get, you can't take advantage of a Roth, right? Because there are income rules that are attached to a Roth IRA. So then you take advantage of a Roth IRA towards the end of your investing career, closer to retirement, through backdoor conversions. And we'll talk more about that. But this is an amazing opportunity to where you could take a substantial portion of your portfolio, move it over into a Roth account, and then give it another 5, 10, 15 years to continue to grow. So what does this look like? So let's say take our hypothetical investor, Sarah. She's a small business owner in her mid-40s, and she has $500,000 that she's moved over into a Roth IRA. It was sitting in her traditional IRA. She's moved it over. She's paid the tax and penalties, and she's got it all over into a Roth IRA. But here's the thing. She's just like, I would invest in the stock market, but I'm a little nervous about market volatility. If I do that, and will I have enough money in, say, 10, 15, 20 years when I'm ready to retire? So instead, she decides to go into a note fund investment like our passive investing real estate debt fund. Now, here's the kicker. Over the next 15 years, her portfolio, so that 500,000 would net her 9% annually. Okay. A lot of investors would kind of scratch their head and they were like, big deal. Like I can go into an equity investment, and if it makes it to maturity, okay, if it sells, I might net 17, 18, 20, 25% internal rate of return. All right. So why 9%? Well, think about this. She put that debt investment in her Roth IRA and allowed it to compound grow for 15 years at 9%. She now has $1.8 million tax-free. So she can either continue to allow it to stay in that investment, and now it's kicking off $150,000 annually for her, or she could start withdrawing down on that 1.8 million. I don't know why you'd want to do that, but some people would, some people need to, okay? So essentially she now has created in a short amount of time, in theory, a very powerful income stream for her. Why is that? It's because she took a stable cash flowing asset and put it in a tax advantaged account and let the magic of compounding growth work for her. So what are our steps here? How do we make this happen for us? Well, step number one is that we need to fund our Roth IRA. Okay. And we can do it a couple different ways, right? We can do it through annual contributions, which if you're below 50 are $7,000 annually. If you're over 50, depending on the tax year, okay, if we're moving into 2025, it's $8,000, but for 2024, the catch up, I believe, was 7,500. So depending on when you're looking at this, you might get a little bit of a bump in catch up due to your age. All right. So that's the first thing, is we got to get the money in the Roth. Now, $7,000 a year, or even $8,000 a year, that's slow. That's a slow train to get moving. But you could also consider, if you have money in, say, a traditional IRA, performing what we call a Roth conversion. Okay, if your income is, and this also applies to my investors, if your income's too high, converting funds from a traditional IRA over into a Roth IRA. Okay, you pay the taxes now, you pay them once, okay, one time. So essentially you're putting a stake in the sand. You're saying, no more. I do not want my taxes on this income to compound grow anymore. Okay. You're now moving that money over in Roth. Instead, you're saying, I want the interest that I would be earning on this asset to compound and grow. Okay. Now the pro tip here is, if you're a small business owner or a small business real estate investor, you are going to want to talk to a custodian to consider opening up what we call a Roth solo 401k. Okay. When you do this, this can be, you can really supercharge how much you put into that Roth IRA. Essentially, if you're a solo business owner, a solopreneur, small business owner, you might be able to put up to, like, say, $66,000 annually into a Roth IRA. And again, that will really help supercharge the growth of your portfolio. So step one, fund the Roth. Step two, let's select the right investments. All right. So once you have your Roth IRA, once it's funded, the next step is to select a secure, consistent investment. We've talked quite a bit about the real estate debt fund. Okay, that offers, ignore the slide here. It actually offers monthly liquidity. You can, call your capital due at any point in time. It has monthly cash flow, has a targeted return of between 6 to 10%, depending on your investing tier. You can also invest in what we call a promissory note. That provides, short-term fixed income for a particular asset. All right, and so, and you can also, get a little bit outsized growth, and I shouldn't say equity-like growth, but like cash flow type like growth outside of upwards to say 10 to 12%. Now, these options are, our options here at passiveinvesting.com, but they pair really well with a Roth IRA. Okay, so step one, fund your Roth. Step two, pick the right investment to go in there. Step three, continue to reinvest to maximize your growth. All right, we've been talking a lot about how do we amplify and get to our end goal faster when we're investing. And one of those things, any business owner will tell you, reinvest as much as you can back into your business early and often in order to maximize your growth, accelerate your growth. It is no different for real estate investing or any type of investing, really. So continuing to invest your returns, in a tax-free account like a Roth IRA will help your portfolio compound and grow faster. Okay. You can also do the same strategy within a Roth solo 401k. All right. But really the magic here is taking a asset that would otherwise be taxed and putting it into an environment to where it is tax-free. Okay. And allowing it to compound and grow. So let's wrap up here today before we move on to our Ask Me Anything part of the show. What is the best way to maximize tax-free wealth utilizing a Roth IRA? Well, one, decide how you can best utilize the Roth, right? Is it through annual contributions? Is it through a Roth conversion? Or is it through opening what we call a Roth solo 401k? Okay. Two, fund your Roth. Make sure you get the money in there. All right, you can open the Roth, but if you never fund it, it's not, working for you. Number three, select the right investments to go in there. Four, continue to reinvest for maximum growth. Guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything part of your show. But if you're listening on your favorite podcast player of choice, make sure to go over to passiveinvestingwithwhitney.com. There, you can get priority access to our deals, hop on a one-on-one phone call with me to discuss your investing goals, and get access to future education like our masterclasses and other resources. All right, guys, take care, and I will see you in the Ask Me Anything. Awesome. What did you guys like? What would you like to have seen there? What was a pearly nugget that you picked up? How can you utilize this in your own portfolio? Guys, I had a couple of people raise their hands. Make sure to go over to your Q&A box or your chat box, type in your questions. We don't have mics available on this webinar, but happy to answer your questions. Jump on over to that Q&A box and we will get them answered. So I will share with you a little bit of my investing journey is, in this particular market cycle, I've been adding a lot more debt positions to my particular portfolio. And when we were in the equity, the hyper growth part of the portfolio, I wouldn't necessarily I have put my equity investments in my IRAs because I don't want to pay like UBIT taxes. Okay. I'm not terrified of them, but I just didn't do it. But now that we're in that phase of the market cycle where it makes sense, total sense to diversify into debt, I've gone back to contributing to my Roth. Now, one could say that I lost a little bit of, power in building my Roth, probably. But super excited, when you pencil out that math, like, by the time my husband and I want to retire, we're going to have, just in our Roth alone, it'll kick off over $200,000 of annual income for us. And that, if you combine that to what we were talking about last week on how to calculate your retirement cash flow, that's just the Roth side of things. That's not like with our other equity asset investments. That's not with what debt investments we hold personally. It's super powerful, and it doesn't take that much time if you can not touch it and allow it to compound and grow. Do you have the flexibility to invest in whatever we want in a Roth IRA? So it depends on where it's held, right? So yes, you would need, if you wanted to invest in something like the PIC real estate debt fund, you would need to have a Roth IRA held at a self-directed IRA custodian. I personally use Advanta IRA. Other people that some of our other investors use are like New View IRA, New View Trust, I think is what it is, Quest IRA. There's a handful of others to check out. And here's the thing, you can have a Roth at Vanguard and it be stocks, bonds, and mutual funds. And then you can move some of that money into a self-directed IRA and have, some note investing there, right? It's not like you have to have all at a self-directed IRA or all at Vanguard. Okay. You just need to know that combined contributions across all of your Roth accounts, if it's a, personally held Roth, not a solo 401k type Roth, but a personal Roth, you have to meet those requirements throughout the year, which is like up to $7,000 if you're under 50, or in 2025, if you're 50 or over, it's $8,000. Wouldn't you have a self-directed Roth to invest in your debt fund? No, and again, I answered that. Yeah, you can't invest through your brokerage account. You'd have to invest through a self-directed, IRA to put it into notes. Now, here's the thing. Your Vanguard, Fidelity, Schwab, they say self-directed IRA. And that means self-directed with what they offer, not with like all the different things that you can put in your portfolio. Sorry, it looks like my video froze. Hopefully you guys can still hear me. Somebody go over to chat box and let me know you can still hear me. That would be great. Hey, we're back. Awesome. New View Trust, NUVIEW Trust. Somebody mentioned I would recommend having a backup plan for Roth accounts just in case the government decides Roths can be taxed at some point in the future. Yes, and just they have, they have changed, the Roth structure over the years. That, if anybody's heard the term PayPal mafia, that's how Peter Thiel and a lot of the people in PayPal made bazillions of dollars. And that's not a true number, but a lot of money is that they put the money in their Roth account, dumped millions of dollars in their Roth account, invested, hit it big on some venture capital deals, and it grew tax-free. I mean, they're sitting on millions and millions and millions of dollars, probably, I don't even know. But so some rules changed from that specific case, and there's been other cases. But here's the thing, is that the rules usually generally they grandfather, and I'm not saying this is going forward, but they generally grandfather in the current accounts. Okay, and then any future accounts, the rules would change. And so if you don't have a Roth open currently, it might behoove you just to have it open and fund it, whatever you can, $500 a year, $1,000 a year, just so you have an account with the current rules in place. So that is a strategy. But yes, any retirement account is what we call a trust account. It is not actually your money in there. It's for benefit of Whitney Elkins-Hutten. Okay, so it is subject to the government rules. Now, definitely, traditional accounts, I can see a lot of rules changing with those in the next few years, for sure. Compare use of Roth versus traditional IRA is how they differ. Okay, so let's go back to our hypothetical investor, Sarah. Sarah took $500,000 and she put it in, so she was able to get $500,000 over into a Roth, whether she funded that directly or she it's a Roth Solar 401k, or maybe she did a conversion, but she starts out with $500,000. She invests in a note fund at 9%, and for 15 years, she gets to that $1.8 million nest egg in her Roth. That $150,000 that she takes out annually. So now, instead of allowing it to compound and grow, she wants to turn on the cash flow spigot. She was like, I'm done allowing that 9% to compound and grow. I want the cash flow. I want that to be my income. I want to go travel. I want to play with the grandkids. I want to do whatever I want. Okay, that $150,000 now comes out tax-free every single year. Why? Because it grew within a Roth. Okay, let's put Sarah down for a second. Sarah's sister, Sally, has $500,000 and was just like, Sarah, you're nuts. I'm just going to leave my money on the traditional side of things. I'm going to invest in a note fund there, and I'm going to build up in 15 years to $1.8 million nest egg. Cool. Sarah now is withdrawing, and she turns the cash flow spigot on, but instead of that $150,000 coming out tax-free, it comes out fully taxed, right? Because let's say her effective tax rate is 28%. Okay. I mean, we're just picking an arbitrary number, but that's a pretty nominal, tax rate at that point in time. So that $150,000 is not $150,000. It is now, she's paying 28% in taxes. So now she only has, instead of $150,000 annually, she has $108,000 annually. Okay, bad. Ugh. It gets worse because Sally let that grow in her traditional account, as opposed to trying to figure out how to go to her Roth account. That $108,000 that she took out now triggers what we call provisional income. That provision, now we're getting into like pretty deep down this rabbit hole, but now that provisional, because she triggers provisional income rules, now she might be subject to some sort of double taxation of her Social Security. So instead of having $150,000 like her sister Sarah does, and Sarah gets to take her full Social Security benefit, because Roth IRAs, income from Roth IRAs, do not trigger provisional income. This is like investing 401 level, guys, okay? But this is huge. So say both Sarah and Sally get $40,000 a year from Social Security. Sarah, because she did it all through a Roth, now has $190,000 to live on. Sarah, now she only has 108 from her traditional IRA that she's withdrawing, but now she's caused a double taxation on that $40,000 for Social Security because she triggered provisional income. I don't know what the number would be, but my guess is that she would probably only have $120,000 to $128,000 to live off of. That's a substantial difference. Okay. And so here's the thing. Do not take all the numbers I threw out here as gospel truth. I want to open up your eyes to the possibilities here. And if you're within 10 to 15 years of retiring, sit down with a qualified CPA that loves this stuff. Not your BFF, probably not the CPA that you've been with forever, who is just like not advising you to do these moves already, but somebody who just eats, lives, and breathes backdoor Roth conversions, loves private equity real estate, and they can help you figure this out. Okay. I will tell you, I am putting myself in the position to where I don't trigger provisional income and I'm getting tons of cash flow. whenever I retire. Can you hold a self-directed IRA at Fidelity? No. Self-directed IRA, those are separate custodians. Like I said, because don't let the term self-directed, the way Vanguard, Fidelity, all those guys, Charles Schwab uses self-directed, just means you get to choose from their menu of investments. Our pick real estate debt fund or promissory notes will not be on their menu of investments. You have to go with a different custodian for that. Okay, like I said at the beginning, Advanta IRA, New View Trust, Quest. There's a number of others, out there, but those are, like I said, I use Advanta, so I'll go ahead and mention them. At what age are the Roth IRA funds available as yours with no IRS dipping its dirty hands into it? Well, here's the thing, the Roth IRA, the IRS is not dipping its dirty hands into it like it is with the traditional IRA. But maybe you mean that the money is freely yours to take without any penalties. And right now that stands at age 59 and a half. But typically so we had another listener say, what if the government changes the rules? If you're sitting here sweating it and going, well, what if the government changes the rules and now it's 62 or 65, right? Because people are retiring later because they have to. General population has to. They generally grandfather in the current accounts, and that applies to new accounts generally. But I always like having contingent plan A, plan B, plan C, right? But 59 and a half is generally where you can start taking monies out of that account and not pay a penalty for it. Now, here's the thing. The cool thing about a Roth, again, guys, I'm not an advisor, CPA, or anything like that, but the cool thing about a Roth is that you can have it kind of double as your emergency fund account. And what do I mean by that? Because you've already paid the taxes on any contribution that goes into a Roth account, you can pull out your contributions at any point in time and not pay taxes on them. Okay, now if you pull out any growth on the account, now there's some time provisions, guys, don't go doing this on your own. Talk to your CPA if you have to pull money from a Roth. I hope you don't. But there's some time provisions. You might have to leave it in there, say, 5 years before you can actually pull the money out. But because you've already paid the taxes on the basis, the money that you've contributed to the account, generally you can pull that basis out of the account, tax rate and penalty free as well. Woo! Great questions, guys. How can you know if any given debt fund has any UBIT, UBTI, or UDFI reported on the future K1s? Okay, so generally a straight debt fund, if you're the bank, does not trigger UBIT. And UBIT, UBTI, same thing. UDFI, unrelated debt financing income, is what triggers UBIT, and UBIT, unrelated business income tax. So that's how, if somebody's like head spinning with alphabet soup, that's how all those things are kind of tied together. Ask the operator before you invest, that question. Does this investment kick off any UBIT, UDFI, which would trigger UBIT? And can I see an example K1 to take back to my CPA? Okay, now, not all operators are equipped to hand over a K1 if it's like individual debt investments, right? Because they may not have actually run a K1 on that investment that year. So it would only be a model. But if the fund, like our real estate debt fund, it's been going for a while, you can, I would imagine you could get a Model K1 and take that to your CPA. But that is what I would do before you invest. If you've already invested in the deal, and the deal, you notice on the deal at the end of the year, it's kicking off, triggering UBIT. I mean, now you've got to make a judgment call if you want to get out of the deal or not somehow, if you can. Here's the thing, before liquidating any investments just for UBIT reasons, I would always have your CPA run a model calculation before you do so. I did that. I put an equity investment in my traditional IRA account. I knew it was going to trigger UBIT. The asset sold. And I was like, oh, okay, I am handing over 2 to 3% of my return to taxes. But two things happened. One, I had enough losses to cover it in my personal side of things. We were good. But on the other piece is I still made like a 16% return. Whereas if I had chose a different investment to put in there, I don't know if I would have made that level of return. So again, I would always take these things to your accountant to model your own situation, because you might have something sitting in your situation, assets that have already been liquidated and on your, the losses are on you, or capital gains are already sitting on your tax return. And every tax situation is going to be different based on that. Tons of great questions. What else do you guys have? I'm going to hang out here for another minute. If you guys have any more questions, let me know. Otherwise, as always, thank you for taking time, not only to spend it here with me, but to invest time in yourself, in your learning. If you're interested in learning more about our real estate debt fund or our promissory notes, be sure to reach out to me at whitney@passiveinvesting.com, and I'd be happy to connect you with one of our investor relations team members, and they can talk to you further about the investment. What happens to debtors that okay. So if we lend money to, we're talking about the real estate debt fund, I assume. If we lend money to somebody that doesn't pay in a debt fund, and the debt fund has to take the asset back. Well, I mean, what happens if that person fails to pay, right? If we lend money to somebody, what happens to the lendee? Well, it depends. It depends on how the debt fund's structured. I can tell you how ours is structured. First thing, we're going to know probably before they will that they're in trouble. And there's some things that metrics that we track. Like for one, since it's fix and flip real estate, if we haven't seen them take a draw on their asset in the first 20 to 30 days, we're on them like immediately, like, what's going on? Is there a project moving forward? What's happening here? Yeah, they have 6 months and they totally could take it all out at the 6-month mark. But why would you do that if you're running a cash flowing business? We usually can often tell before they know that they're in trouble. And so we're trying to work with them, not to bail them out of their situation, but possibly partner them with an investor that could take over the asset and get them out of the asset if they need to be out of it. But out of over 1,400 and 1,450 loans, we have had 3 defaults. Okay, foreclosures, I should say, where we had to take the asset back. No deficiencies in our fund, meaning we've been able to dispose of that asset oftentimes, and bring additional monies into the fund. But we have for one, our managing partners, over that fund, they themselves have over 40 years of flipping experience. I mean, not that they're going to have the bandwidth to take it over and flip, but they've got a deep network of investors that could probably take over the asset. We could REO the asset, we could sell it off just as is, we could complete the rehab and make even more money. There's a myriad of different ways that we can get out of that. But yeah, the last step would be to foreclose on the asset and take it back. Okay. Now here's the thing. Industry standard on a debt fund is 1 to 3% of the loans that you write are going to be foreclosed upon. 1 to 3%. That doesn't sound like a lot. Ours is less than 0.02%. We are aiming for 0. We don't want any. We've had 0 deficiencies. Take care. I mean, this isn't about how do we vet a debt fund. Happy to answer more of those questions, but take care, because some debt fund operators are just playing a numbers game. So beware, buyer beware, investor beware on that. What is the expense ratio for a debt fund like yours? We don't have an expense ratio. So our investors get their full preferred return before any expenses are charged to the asset. So how does that happen? How can we do that? Well, essentially, we're using the expenses that we charge. The closing points that we charge the lender to actually like run the business. So that means your full capital is at work for you, which is very cool. That is not a lot. That's not how most debt funds do it. Okay. Most debt funds would roll all that together. They would charge all these expenses to the debt fund. So they're charging the person they're lending money to a bunch of fees, and they're charging the investors a bunch of fees. Essentially, the business is run. The investors are purely bringing the money in and bringing the bank. That's it. If we use the 1031 to benefit the tax advantage, would this have the same effect as vesting in the Roth? No idea. You would need to, talk to your CPA on that, because again, it depends on what you 1031 into. You're continuing to kick the tax can down the road, so to speak. I'm just thinking through this out loud. You would have to keep enough depreciative losses to shelter all your income at any point in time. You'd have to continue to kick the tax can down the road and hope you don't have any sort of loss in capital at any point in time. And then you'd have to die with the asset in place. That way it went to your heir with the step up in basis. So a lot more strings to pull there. And I will put it to you this way, not a lot of investors actually have the bandwidth to pull something like that off. So it does take a lot. And sometimes the best time to 1031 to sell an asset is not the best time to buy an asset. So I have executed I have started 8 1031s and I've only completed 3. Because sometimes it's really hard to find the next asset. But possibly pencil all that out with your CPA. Can you 1031? Okay, so here's another question. Can you 1031 a single family home into a debt fund like ours? No. Why? Because your single family home is an equity asset. Okay. So the debt fund is a debt investment. You have to sell the home and pay the taxes on the sale of that property. Okay. If you have other losses on your tax return that could, help offset the capital gains that you might have in that sale and the depreciation you recapture, cool. And then you could take the funds and then invest that into the debt fund. Okay. But you can't think of it you can't 1031 exchange between real estate and operating business. It's kind of the same thing, right? You're going from a real estate holding to an operating bank. Ish. That's kind of how I keep it straight in my head. So you can't 1031 because you're in different layers of the capital stack then. Is your debt fund largely hard money lending? Yes. Average loan duration is 6 to 9 months. Wondering how you earn a 6 to 9% otherwise. So if you invest $25,000, it's 6%. If for investments 100,000 to 500,000, it's 8%. Investments of $500,000 to a million, it's 9% preferred return. And then for investments of $1 million or over, it's a 10% preferred return. So there's, different ways to do that. And then if you allow it to compound, like if you take $100,000 investment and allow it to compound for 10 years, it's a 17% return, 17.1% return. So you can get an equity-like return, with taking a really low risk in the capital stack. Why are there debt funds paying? Oh, this is my favorite question. Okay. Gonna blow the doors off of this one. Why are there debt funds paying 15%, but yours and many others are lower return? Okay. So debt funds, just because I say debt funds just means they're in a bank layer of the capital stack. That's it. It can be a first, like for our fund, it's first position lien on fix and flip real estate. Very plain and vanilla. It's single family residential real estate. That's it. Okay. Other debt funds might do 20% single family, 30% multifamily, 50% construction debt. And then another, what are we at? Okay, 40% construction debt. And then another 10% secondary notes, distressed notes. Okay, so the blend of all that is higher. The rate of return might be a little bit higher. Okay, but what kind of risk are you taking? And do you want to be exposed to that risk? I don't know. I don't want to be exposed to construction debt right now or secondary distress debt. Not my jam right now. This is not, I want capital preservation. Also, those type of debt funds offer very, the liquidity of that, I've started to see in the market of those type of debt funds dry up a little bit because the multifamily debt is a little distressed. Construction debt is distressed. Distressed debt is already distressed. And so they are not cycling out as quickly as they should be to provide the liquidity in the fund. Okay, so that's problem number one. Problem number two, a fund like that, in order to smooth capital contribution and withdrawals, are probably taking on a line of credit in order to juice the returns, meaning they're taking your money to the bank to get more money to lend out. What kind of risk does that introduce into the fund? No, I don't like that kind of risk. I think a 10% line of credit might be okay. But anything above 10% in my book is you're taking an unnecessary risk for what this investment should be doing for your portfolio, right? Remember, stabilize cash flow, limiting volatility, taking advantage of where we're at in the market. Okay. Here's the last little puzzle piece. When you have funds like that that are paying a larger percentage, I would always ask the question, are you lending money to yourself on your projects? Okay. So now you've got self-dealing, which as long as they disclose it in their private placement memorandum, no big deal, right? It's totally legal. But now you're introducing another layer of exposure there as well. Okay. Just again, not my jam. If you are in the position where you want to hold debt in your portfolio and you want to take a lot of risk, then maybe a fund like that is a perfect match for you. If you want to take, but for me, if I'm going to take that risk, I would be on the equity side of the deal every single time. I would. How do you invest your debt fund? Can you provide the breakdown of your returns? Yeah, you know what? It might be best if anybody wants details over the debt fund, email me at whitney@passiveinvesting.com. I will send you the offering memorandum and you will have everything at your disposal. But essentially, how do we generate the returns? It's super silly, simple, very straightforward. straightforward. It's like almost so simple that people can't wrap their heads around how simple the business is. We lend money on fix and flip real estate, somewhere between depending on the borrower, 12 to 14%. Okay, they pay about a 2%, 2% in points to close the loan. We take the points to run the business, all the money from the points to run the business. And then, the 12 to 14% loan goes into the pool. All of our investors are diversified across the entire pool of loans. And then based on your investment level, you either get a 6% preferred return up to 10% preferred return. Very simple. Monthly cash flow if you want it, or you can allow it to compound. And then we say 90-day liquidity. As soon as your money is invested, you can actually call it due. And then we have, 90 days to get it back to you. Our average, return of capital is about 21 days. Now, if you invest $500,000 or $1 million, if you want that higher preferred return, there is a little bit of a lockup on that, either a 6-month lockup or a 1-year lockup in order to get the higher return. Or you can invest $1 million and get an 8% preferred return. Entirely up to you if you don't want to have any lockup. But that's it. That's kind of like the nuts and bolts of the business. Pretty straightforward. We have an 85% return borrower rate, so we know our borrowers inside and out. We're in it to build long-term wealth and business with our borrowers. Awesome. Probably have time for one more question. I don't see anything else in the chat. So I asked this at the beginning, was this eye-opening for people to see how much wealth they could build in a Roth account in a short period of time? I thought it was. Somebody says, how is your business model different than Fundrise? I am not specifically familiar with Fundrise. I mean, I used to be very familiar with them, but not right now. The best Fundrise is generally a REIT. So those are taxed a lot differently, which might be a good pair for your traditional IRA if you wanted it. Sometimes REITs can come with some tax advantages to it. I'm not aware that Fundrise actually does that anymore, but for us, it's, do you want transparency into who you're lending money to? And that's one of the biggest things, with our business is that the team inside and out. You don't have a big corporate entity running the show. We have a smaller, tight-knit team that is running a very well-oiled and low-expense overhead business with no expenses. Is essentially all your capital is at work and not being eroded by expenses and fees being charged. How do you time the IRA to Roth conversion for the best tax results? Talk to your CPA because they're going to be the ones that intimately know your situation. And so I would say most people I've heard of start doing the Roth conversion probably about 5 to 10 years before retirement. So what the Roth conversion is, super high level, is that you're starting to take chunks of your traditional IRA account and pay the taxes on it to move it over to the Roth side, essentially. And so you don't have to pay any fees because you're technically not withdrawing it. There's a mechanism that allows you to roll it over, but you are paying the taxes on it today's rate. But then it gets to grow tax-free from there and compound tax-free, right? As opposed to compounding your taxes. That's what a lot of people don't realize. In a traditional IRA account, that was never meant to be a retirement account. It was meant to be an account for high income earners to defer income to later years of life. That's it. It was never meant to replace a pension. But it has in most cases. And so we need to manage that accordingly, if at all possible. The sweet spot is if you think you're gonna, from everything I read, if you're gonna be retiring, and your IRA account is going to have more than $500,000 in it, the odds of you triggering additional taxes in your situation are going to be super, super high. So the earlier that you can get on it and talk to your CPA and come up with a strategy, the better. When do you see the debt cycle switch downward? I think if we look at and we're going to make this the last question. If we look, the four parts of the market cycle, recession, growth. Well, let's start off with like growth, hyper supply, right? We're like at the top going down, and then hitting into recession and then recovery, growth, hyper supply, recession, right? Just calling those four cycles. One, it is local dependent, right? Some areas in the United States have been in the recession or moving through. And I know you guys are putting in a ton more questions. For time, this will be our last. I'll finish wrapping it up. You can always email me at whitney@passiveinvesting.com if you want me to answer more questions there. Totally cool. But as we go through these cycles, one, we got to look at the different areas of the United States and where they are independently of each other. But on a whole, there are some indicators, red light indicators that are saying that we are either in a recession or heading toward a recession. That all we've done is kind of kick the can down the road a little bit, and that it's either here and we're moving through it, or we're going to be heading right smack into it very quickly. The leading economic index, typically when it drops below 4.5%, or if it gets to 4.5%, negative 4.5%, I should say, we're at recession territory. It's at -6 right now. And then unemployment, whenever you see a rolling 3 months of like a drop of more than 0.5% in unemployment, or a rise, I should say, in unemployment, say like you went from 4.1 to 4.6, that you're starting to head into recession territory. We're teetering on that number, pretty close. So there are some red light indicators that are going off. What we do with that, I don't know. Market corrections are part of the game, are part of the investing game. We have to learn how to invest and navigate through them. That is one reason why I'm so passionate about helping you guys invest in different parts of the capital stack to stabilize your portfolio and essentially prepare for the next recession today. Because it's not a matter of if it's going to happen, it's a matter of when. And we want to have that stabilized cash flow in our portfolio. And if we can know how to grow it tax-free and allow it to compound, that way we don't feel so pressured to go into super, super risky equity assets all the time. Okay, we can kind of take our time. So I'm trying to empower you guys to do that. All right, guys, thank you so much. Susie, yay, my pleasure. You guys have been great, amazing questions. If I didn't get to yours, please reach out to me at whitney@passiveinvesting.com. We'd love to field your question there. Also, if you want more information about the debt fund or the promissory note, reach out to me there as well. You guys take care. Talk to you soon.